Okay, this is November 2017. Question 2, FR paper. Last time we discussed some questions about IAS 41. Let me hope you had time to go through. Part B of this question, we are told to prepare a reconciliation statement of the carrying amounts of dairy livestock at the Majembere dairy farm. How do you prepare a reconciliation statement when you're dealing with this kind of question? Now, the starting point, always know, as you prepare the reconciliation statement, always know what you started with. What was your carrying amount at the start of the year? You need the carrying amount at the start of the year. That is 1st July 2016. Do you have some livestock as at that date, at the time you started the year? Do you have some carrying amounts? Do you have some livestock? Okay, so you need to read through and see whether you have. Okay, so we are told that 16 6-year-old animals, that was at 1st July 2016. Do we have any other? When you read additional information, they told you during the year 10 7.5-year-old animals were purchased. These ones were purchased during the year. So the purchase comes after. The purchase comes after. You first deal with what you started with. So it means that we are going to start with, because here next paragraph they are telling us that during the year 1 7.5-year-old animal fell in a ditch and became incapacitated. Okay, so this is during the year. So at the start, we had only 16 6-year-old animals. So we record that. We had the 16. We have the 60. Those were 16 6-year-old animals. Remember, we'll be looking at the fair value less cost to sell at the start of the year. So these ones were just the value given in the question. The value given was 44,800. 44,800. That was the value. So we are keeping at 3 zeros. So we had only 6-year-old animals at the start of the year. Now, after that, you're going to look at the purchases made during the year, the acquisitions made. The acquisitions during the year, or the purchases made during the year. Okay, and When you look at the question, do you have those animals that were purchased during the year? They told us that during the year, 10 7.5-year-old animals were purchased at shilling 3 million each. Okay, those are the ones that were purchased. Those are the ones that were purchased. So we are going to capture that. We are going to capture that. 7.5-year-old animals. 7.5-year-old animals. Don't confuse the animal that were born during the year with the animals purchased during the year. Okay, don't confuse that. Now, after that, what you're going to look at is the fair value changes. The fair value changes. Now, the fair value changes. The change in fair values due to, remember, we look at two things. You look at the one due to physical growth, and another one due to market changes. So change in fair value due to, let's start with due to market price. Due to market price changes. And now, as you deal with this, one, you are going to look at what you started with. Of course, here you're looking at markets. Okay, you're looking at markets, the changes in the market. You started with what? You started with this 6-year-old animals. So we have the 6-year-old. You have the 6-year-old animals. Then you have the 7.5-year-old animals. But here you are going to also bring in the newborns, because you see at the end of the year, you are also going to bring in the newborns, the newborn animals. But it's good to make the working, it makes it a bit easier. Let's do some working this side, and so that you can understand it clearly. Okay, so we are looking at what? We are looking at the fair value changes due to market price changes. You are going to first look at those 6-year-old animals. 6-year-old animals. Now, with 6-year-old animals, at the start of the year, that is 1st July 2016. 1st July 2016, you had what? You had what was the value? What was the price? What was the price for these 6-year-old animals? You get this value, 44,800 divided by the number, the 16. So we want to know the price of each. So the price was what? We get that is 44,800, then divided by 16. What do you get? Here, what do you get? 44,800 divided by 16. That's what I have. Then the question is now, at the year end, that is 30th June 2016. What is the price? What is the price? What is the price? The same age. The price of the market, the fair value of this 6-year-old, the same age. Because here you're trying to find or to look for the changes in the market value. So what is the price for 6-year-old animals at the end of the year? So you have 48, we get 48,000 divided by 16. We get that 48,000, 48,000 divided by 16. It should be the same number, okay? What do you get? 48,000 divided by 16. That's what I have, okay? So it means that the total change here, the total change, the total change is the number of animals, 16 and 16 times what is the change here? Of course, the change is 3,000 minus 2,800. How much do you get? You look at each separately. 16 times this minus this. So that is the change. So that's what we are going to record this side. This is what we are going to record here. I can put here working one, then I record just the change for this. And I put how much? What is the change for this? 3,200. You do the same. You do the same for another category. That is 7.5. 7.5 old animals. Now these ones were purchased during the year, but what were the purchase? What were the purchase price at the time they purchased? These animals, 7.5-year-old animals, what was the price of each? Okay, we are told that during the year 10 7.5-year-old animals were purchased at 3,000 each. So, sorry, at 3 million each. So what does this one mean? It means that do we have the period? We don't have the period. We just say the price at acquisition. The price at the acquisition date. The price at acquisition date. It was for each animal, it was the 3 million. We are keeping 3 zeros. Then what is the price at year end? The price at year end. What is the price at year end? For these animals, 7.5-old animals, what is the price? Do you have the price? The same, you must have the same number. The same number. Don't rely on another. Because you purchased 10, you must be comparing with the same number. Okay, so here it's 7.5-year-old animals, and what do you have as the price? You get 34,000 divided by 10. The price at year end, 34,000. Okay, here I'm going to get 34,000 divided by 10. What do you get? You get 3,400. So what is the total change for these 10 7.5? Total change, how many animals are 7.5-year-old? 10. times the change, which is you just get the other change, 3,400 minus 3,000 minus 3,000. How much do you get? Okay, next, newborn animals. You want to know the price at birth? What was the price at birth? Then you compare it with the price at year end. The price at year end. Okay. So do we have the price? Let me see. Do we have the price? Okay, okay, 7 animals were born during the period between November 2016 and March 2017, valued at shillings 720 each, 720,000 each. And when you look at your data, the question is, do you have seven newborn animals at year end? If you don't have, you don't need to look at that. But when you look at this, at our data, we have the 7 newborn animals at year end. So it can be easy for us to compare. So here we are going to say here the price at birth, it was 720 each. These are 7 newborn animals. Then price at year end. How are we going to get the price at year end? Get this figure, 5,740 divided by 7. So we get what? We get is 5,740 divided by 7. What do you get? That's what I have. So compare and get the total change. The total change, how many newborn animals? 7. 7 times the change. 820 minus 720. Okay. What do you get? You get this minus this. The answer you get multiplied by 7. So that's what I have. That's what I have. So it's what I will record here. Here we have working, still all of these are working 1. This is your working 1. Even here it's your working 1. This is what? This is 4,000. Then here it's what? 700. So you are done with you are done with market changes. Change in fair value due to market changes. Okay. Now you may be wondering why we are not talking about what 9-year-old animals. You don't have what to compare with. This one you don't have what to compare with, so you cannot. Now this one you cannot look at it. Okay, next. Next we are going to look at the fair value, the changes in fair value due to physical growth, due to physical changes. It will be still the same here. but I will do the working for each. So working number 2, this was working number 1, talking about the fair value changes due to the fair value changes. So number 2, it's a fair value changes. The fair value changes due to physical growth. Okay, so how do we do this? How do we handle this? It's also the same. It's also the same, but just take note that with physical changes, you look at it can only happen at year end. This one, it can only happen at year end. Now, if you're looking at 16 6-year-old animals, if you're looking at 16 year-old animals, now the question is, what is the price? Remember, if you're dealing with 6-year-old animals that you had at start, the 6-year-old animal that you had at start, currently they are, currently they are what? If you started with if at the start they were at the start they were what? They were 6-year-old. Now at year end they must be 7, isn't it? Isn't it, colleagues? At year end they are 7-year-old. So it means that we need to look for the price or for the fair value of 7-year-old animals. And here they told us that all animals above 5 years of age were valued at shillings 4 million each, while those below 5 years of age were valued at 1 million each. That is at year end as a result of their physical changes. So that one means that if you're looking for 7-year-old now, the 7-year-old now is valued at 4 million. So it means that here I'm going to get the price attached, the price of 7-year-old animal. And the price of 7-year-old animal is what? Is 4 million. Okay. Then what is the price? Now the question is, as you do this, the question is, for your 6-year-old animal at year end, what is the price? What is the price? So what is the price? What is the price of your 6-year-old animal? Because you're looking at physical change, at physical change, the one that were 6-year-old is now 7. Now, what is the price of that 7-year-old? It's 4. Then what is the price of 6-year-old animal at year end? Here we are looking at year end. All of them we are looking at year end. All of them at year end. This is at year end. We saw that. We have it somewhere. What was the price at year end? It was what? Was it 3,000? Or what am we taking? 6-year-old animal at year end, you will go to the 48,000 divided by 16, which is 3,000. It's here, this one. Okay, so the question is now, what is the total change? What is the total change? The total change will be, how many animals are you talking about here? For 6-year-old animals, they were 16. So you get 16 times the change. 16 times the change, which is 1, which is 1,000. It's the 16 times 1,000. So that is what you should do. Capture. Then next, now you're talking about the 7-year-old animals, the 7.5 a year-old animals. Now, the 7.5-year-old animals, it means that if you purchase them during the year, okay, we cannot tell the time you purchased these animals, but the assumption is now, since they gave us the price, since they gave us the price of 5 years of age, that since they gave us the price of animals that are above 5 years of age, then we are going to rely on this. Because if you purchased your animals during the year, you don't know when you purchased them. Just that the assumption now is that they are above 5, obviously. They are above. Now it could be, let's say, 8 years, depending on when you purchased them, or 8 years and 3 months, depending on when you purchased them. Okay, so what will happen is that for you will use this 4 million. Okay, because here you cannot tell the age. So you will just say price attached for animals above 5 years. For animals above 5 years, it is 4,000. Then the price of those same animals at year end, of the price of the 7.5-year-old animals at year end, it was what? At year end, it was what? We had that. It was what? At year end, it was 3,400. So compare the two and get the total change. Okay. So the total change will be, there are how many animals? There are 10. 10 times the change, which is 10 times the change, 4,000 minus 3,400. How much do you get? This is 10 times 4 minus 3,000. So the total change here, you have this one. Then lastly, the new bonus. So the newborn animals. Newborn animals. The newborn animals. Now, since you had some newborn animals, what will happen is that you don't know. Okay, what you're given here. What you're given here is that they were born between November and March. Okay, so obviously these ones are still below. They are still below 5 years of age. So those ones are still below 5 years of age. So it means that the value you're going to use for those ones that are still 5 years of age, you're going to say that the price attached for those that are below 5 years of age, it's what? It's what? Call it this. We are given that. It's what? It's 1 million. 1 million. It's here. 1 million at year end. Okay. 1 million. Because these ones, our newborn animals, we assume that they are like now, let's say 8 months. They are still below 5. They are still below 5. So the question is now, those same newborn animals were at how much at year end? Newborn, the price of newborn animals at year end. We are at how much? Someone in the chat is saying 820. Yeah, we have that 820. So the total change will be how many newborn animals? Were 7. 7 times the change, which is 1,000 minus 820. This will be 7 times minus this. So that is the total change. Okay, so I can copy my things and I put them here. So this is working too. Working too. Okay, so here it's how much. The first one was how much? 16. Then this one it was 6. Then last day it was 1,260. Okay, do we have any other information? Let me see. Do we have animals that were slaughtered? Oh, let me see. Okay, during the year, a 7.5-year-old animal fell in a ditch and became incapacitated. The management slaughtered it and distributed its beef to staff. That is number 1. Okay, you have to remove those ones. Okay. Two 6-year-old animals were sold. During the period at 3.5 million each. You have those ones that were sold. The carrying value of the sold and slaughtered animals were estimated at shillings 2.32 million each. So what does this one mean? Because you don't know the price of this, the fair value of this, and the fair here they have given you the sales price. But as long as you're given the carrying values of those two, because here you're talking about the one that was sold and the one that was slaughtered, and they are telling you that the carrying value of those two were at this. So it's what you're going to rely on. It's what you're going to rely on. Those ones must be derecognized. Okay, so how do you derecognize? You derecognize by subtracting. You remember those ones that were slaughtered also, they are already part of your template. So you remove them. You remove them by subtracting. You erase derecognized animals, or the ones that are slaughtered and sold. Okay, I can say slaughtered and sold and slaughtered. So here, what do you have? I don't need to do a working. There are how many in total? There are 3 times the carrying value of each 2,320. Okay, so it means that here I will get 3 times 2, 320 as the value. So finally, you can get the carrying amount at year end, 30th June 2017. Okay, by just looking at that column. So that's what I have. Now, if you want to see whether your things are reconciled, what do? You will look at the fair value. The fair value as at this date, the fair value of these animals are at year end. Okay, you have how many animals that are above 5 years? They are how many? 16 plus 16 plus how many? 16 plus this is 7.5. In total, we have how many animals here? In this question, we have how many animals? The one that are above 5, it's 16 plus 10, which is 23. 23. Remember now, those 23 were what? Out of 26. Out of 26. You have a 1 year animal, a 1 year or a 1 7.5 animal that was slaughtered. Then you have 2 that were sold. All of them are above 5-year age. So it means that now this one, what will happen is I can get the fair value, of those animals. I get the 26 minus 3, which is 23. Then times the fair value of those animals are what? The fair value is 4 million. When you look at what? At your template, the fair value is 4. Because you don't have cost sale. So here you get 23 times 4 million 4,000. That's what I have. Then after that, you also look at those that are below, that are below 5 years. How many? How many that are below 5? How many that are below 5? It means that here you're talking about those that were born during the year, and they are only what? They are only, and they only 7. So you get that 7 total times the 1 million. So here you get what? The 7 million. So if you add the 2, you should be in a position to get the answer. Must reconcile if you add the 2. Okay. So that's how you handle that question. Any question, colleagues? Any question?
This spread a question.
Which screen are you seeing? Oh, sorry.
Excel.
Part B, we advise management of PWL on how each of the above transactions should be treated in the financial statements for the year ended 31st December 2021, giving financial statement extracts. Remember, if it's level 3, they just bring this as as part of section B number, and they just give you these notes. Then they say you advise the management. Okay. Now, what are you given? They are telling us that PWL is a company that deals in agroforestry. PWL harvests mature trees and sells them to manufacturers of various wood-related products. PWL obtained approval to plant trees in northern Uganda as part of government program to increase forest cover in the region. During the year ended 31st December 2021, the following information was availed. 1. In January 2021, PWL purchased 100,000 tree seedlings of pine trees, each at shillings 3,000. So this company purchased the tree seedlings. Okay, they purchased the tree seedlings at this amount of money and planted them in northern Uganda as part of government initiative to increase forest cover in the region. By 31st December 2021, PWL had so far incurred shillings 45 million as maintenance expenses to maintain the tree plantation, and the fair value of the pine tree plantation was the shillings 340 million. So how do you account for this? How do you account for this transaction number one? How do you account for this transaction number one? So this is the December 2020, what? 2022? Question 5. How do we account for that transaction number one? Transaction number one. Transaction one should be accounted for in accordance with IAS 41. That is agriculture. That is agriculture. Since the planted pine trees, tree seedlings are biological asset. Do you agree? So that is in number one. We are going to account for this transaction one in accordance with IAS 41, because these planted pine trees seedlings are actually biological assets. Biological assets, remember, are just living animal or plant. So planted pine trees are biological assets. And the standard says that initially it means that this entity PWL will recognize a biological asset, should recognize a biological asset, that is growing pine trees. Okay, growing pine trees at what? At how much? They should recognize at how much. They incurred the 3,000 for each, so they should recognize at a cost of shillings 3,000 times 100,000, rather 100,000. What do you get? That is 300 million. From what? From 1,000. The number times each. Each is 3,000. Each is 3,000. So initially in their books, they should debit. They debit what? They debit a biological asset and credit the cash or bank. That is initially. Okay. Then subsequently, what should happen? That is on which date? Now, subsequently, we want to know what should be reported in our financials for the year ended 31st December 2021. What should be done from that transaction? So it means that subsequently, that is on 31st
December.
2021.
Mm.
What should be done?
You should recognize the biological asset at the fair value less cost sale.
Yeah. So on that date, the biological asset must be measured, or must be measured at fair value less cost sale. That is subsequent. Okay. But obviously here we don't have cost sale. We don't have cost sale. So subsequent. So since there is no cost sale, then this company PWL, no, the assets, the asset must be measured at fair value of shillings. How much? What is the fair value? At year end, the fair value of pine tree plantation is 340. Are you saying that? 340 million. So at year end, in your records, you should recognize at 340 million. So because initially you had recognized it at 300 million, and now in your books you're saying you recognize at 340, then there is an increase. There is an increase in the value. So that increase should be reported to profit or loss. So the increase of shillings, how much? Of 40 million. 40 million. That is from what? 340 million minus 300 million. Must be recognized or must be reported in statement of profit or loss as what? As an income, isn't it? As an income. It's an income. As an income. As other incomes. And these other incomes, of course, it could be because of the growth of the asset. Other incomes from growth of the what? Of the asset. Growth of the asset. Because there is a growth, you expect the value to increase. Okay. Okay. Is this statement clear? But you see, still in our statement, the company incurred maintenance expenses. These maintenance expenses should be reported where? The maintenance expenses should be reported where? Or you should not recognize. Okay. The plantation maintenance expense must also be reported or recognized in a statement of profit or loss as an operating expense for the year. Okay. Yeah, that's all about what? That's all about transaction number one. Because now if you are to do the drafts in your balance sheet, you will recognize what? In your balance sheet, you will recognize this in your balance sheet. Then in PL, you will recognize this 40 as under other income. Then the plantation expense of how much of shillings, what? It was 45 million. Must also be reported in a statement of as other comprehensive income. Okay, so this one in the balance sheet, then in the PL, 40 as other incomes, then under operating expense, 45. We are done with transaction number one. Okay, so transaction number two, they are telling us that on 1st April 2021, PWL purchased a tree pruning machine this is a machine at shillings 140 million with an expected useful life of 20 years and residual value of 20 million. At the same time, PWL received a grant of 30% of the cost of machine from government. Now, the cost it was 140. You received a grant of 30% from the government. Both the equipment, before the equipment was purchased, PWL had received government approval of the grant. Okay, remember, whenever you're going to some grants are conditional. You must first satisfy the conditions before you receive the grant. Okay, so here you have already received the approval of the grant, so you're going to recognize. So PWL's policy is to charge full year's depreciation in a year of purchase and none in the year of disposal. So the reason why you're given this is to help you get the depreciation. Management of this company is in the process of preparing financial statements for the year. However, there is a doubt on how the above transaction should be treated. So in this transaction, what do you see? In this transaction, what do you see? You see an asset and grant, isn't it? You have an asset and a grant. The asset should be accounted for using IAS 16 PPE. Then a grant should be accounted using IAS 20. Okay. So here we have transaction 2. Transaction 2 should be accounted for. Okay. Okay, let me just first say transaction 2. I separate. The purchase of the tree pruning machine. The tree pruning machine should be accounted for in accordance with the which standard? IAS 16, isn't it? PPE. Okay. This is not an investment property. Hmm? So that purchase should be accounted for using PPE. Hmm? And the grant of how much? The grant of shillings, how much? The 30%. The 30% times 140, how much do you get? 30% times 140, how much do you get? The grant of shillings, that is 42. That is 30% times 140 million. Should from government of Uganda should be accounted for in accordance with which standard? In accordance with the which standard? IAS 20. What is the name of IAS 20? Accounting for government grants and disclosure. You have to put the name of the standard very well, and disclosure of government assistance. Okay. Yeah. Okay. That is, of course, you are accounting this as a deferred. This would be as a deferred income. A deferred income is like a liability, and now it must be now that your deferred income must be amortized annually. You must, like every year you're performing, or you're using the grant, you should recognize it. Here we are using income approach. In a scenario where examiner has not specified, you use the income approach, and I'm going to talk about it very shortly. Now, okay. Now, colleagues, what else should we do? Okay, now, since we have these two things, what should be done? Remember, as you do these workings, you should know now what should be reported in a PL, what should be reported in a balance sheet. Okay? Of course, when it comes to asset, assets initially PPE, that standard allows us initially it says that initially you should recognize the asset at its cost. Then subsequently, the standard allows us to choose between cost model and revaluation model. Okay, isn't it? So because here we don't have issues related to revaluation, then it means that here we are using the cost model, and subsequently the asset must be depreciated over its useful life. Okay. Subsequently, that is as at 31st December 2021. The tree pruning machine. will be depreciated now. Okay, okay, okay. Just a minute. If you want, what can I? Okay, okay. Initially, let me just talk about initially. Because this is the question, section B number, you need it to be somehow detailed. Section B number. Okay. If it is a purchase of a tree pruning machine, that should be accounted for in accordance with this. It means that initially this company, which is, what is the name of this company? That is PWA. PWA should have recognized the machine at its cost of shillings. What is the cost? 140. And entries here, entries that you can pass here, entries would be you debit the PEE. Okay, just in case you want to put T, this is a tree pruning machine. Tree pruning machine. The cost is 140. But now you are crediting what? You're crediting what? You're crediting cash or bank, 140. Okay, that is initial recognition. Then also for this government grant, initial recognition is that you are going to debit. What do you debit? What do you credit? This is a grant. What do you debit? Grant, you're receiving cash. You debit cash. You receive cash from the government. You debit your cash or bank with the 42 million. Then you credit what? A liability, a deferred income. This is like a liability. So we have that, okay? That is initial recognition. Now, as at 31st December 2021, the tree pruning machine should be depreciated. Okay, subsequently, the tree pruning machine should be depreciated. Should be depreciated over its useful life. And also that grant, the deferred income, okay, must be amortized over the useful life of the asset. So what does that one mean? I want the depreciation of the asset, depreciation of the machine. It will be what? You get the cost. Minus residual value, because we are given residual value minus residual value. Scrap, it's like scrap. Then you divide by useful. You divide by useful. You divide by useful life. Very, very key. So here, what are you going to get? The cost is 140. 140 minus the residue. What is the residue? What is the residue? What is the residue amount or residue value? The residue value is 20 million here. It's here 20 million. So you remove the 20 million, then everything you divide by the useful life, which is how many years? 20 years. So how much do you get? How much do you get? How much do you get, colleagues? Hmm? Are you on? That is what? Okay, 60. That will be 6 million. That will be 6 million per 6 million per year. Per annum. Okay. Then what you should recognize every year is amortization. Amortization of grant. What you should recognize amortization of grant is that you recognize, you just get that deferred income, the income you have, which is 42 million, then divided by 20 years. So each year you should be recognizing how much as the real grant or the real income. Okay, that is how much? 42 divided by 20, that is 2.1. So this is 2.1 million. So this is per year. Every year, the standard says every year you recognize this. You recognize this as the actual income. This is not yet an income. This is not yet an income. This is not yet an income. When you start to use that grant, then okay, we say that spread the grant over the useful life. Then each year you recognize this. Okay. Now, what does this one mean? What does this one mean? Remember, you received the grant on which date? It is always good to know when you receive the grant. You receive the grant on which date? You received the grant of 1st April 2021. You are preparing your records. You are preparing your records as at 31st December 2021. What comes into your mind? What comes into your mind? Are you going to depreciate for the full year? When you look at this, we are not going to depreciate for the full year because this happened on 1st April 2021, yet the year is ending 31st December 2021. So we are time portion. So here How many months? From 1st April to 31st December, those are how many? Someone is saying 8. 8 or 9, because, okay, because April is also included. April and December included. They are 9. 9. So we time a portion. We time a portion. Okay. So we are going to get if for the year, for the year, okay, for the year ended, oh, we can do this. We can do this in our financials. We can do this directly in as we prepare the extract. We can, for the year ended the 31st December 2021. Okay, the depreciation here, the depreciation expense will be what? Will be the depreciation for every year, it's 6 million. But now because it's not for the full year, I get 9 out of 12. So how much do you get? 6 million times 9 out of 12. I get 4.5 million. That's what should be recognized. Then the actual income, the actual income or the grant income realized, should also be the 2.1 million times. Remember, every year you should be recognizing this as actual income. So for the year ended that, I expect also this income to be realized. So it's 2.1 times 9 out of 12, which is 1.6 million. Okay. Okay. So before I look at the grant, then it means that in your balance sheet, what will be the value of the asset? The PPE, the carrying value of asset, the carrying value of PPE of machine should be equal to what? The cost minus the accumulated depreciation, which is equal to what? The cost is what? The cost is 140. So we get that 140 million minus the accumulated depreciation is only 4.5 million. How much do you get? How much do you get? 140 minus 4.5. That is 135.5 million. Okay, so that's what should be recorded in your balance sheet. Okay, then with grant, of course, we said that this is a liability. Now, because it's a liability and you have realized now, out of that, you have realized this figure, then it must reduce. Now, what will happen is that what will happen is that this grant is going to be categorized into two: the current liability and the non-current liability. How? You are going to first know out of this, what is left? Out of this, what is left as a liability? Out of this, what is left as a liability, colleagues? The current, the deferred grant now, the deferred income is now what? Is now that 42 million, then minus 42 million minus 1.6 million. How much do you get here? You need to understand this deferred grant, deferred income, very, very key. You remain with 40.4 million. Now, this 40.4 million is going to be divided into two. This 40 is going to be divided into two. Okay, in an exam, you don't do this. You should just say that this must be split. This must be split into two. This, okay. This must be split into two. The current liability of what? Which grant do you expect to realize within the next 1 year? Which grant do you expect to realize within the next 1 year? It's the one this one. Are you seeing this? It's the one we expect to realize within the next 1 year. Because every year we are saying that every year you claim this. So we expect that in the next 1 year, after your balance sheet date, you expect to realize 2.1 million. So that is the current. The one you expect to realize within the next 1 year. It means that non-current liability is how much now? The balance for 40.4 million minus 2.1 million. You need to be very, very sober here. Very, very sober. So here, what will be our balance? So the balance is 38.3 million. And that's all, colleagues. Really, that's all. Just that what is left, is to prepare the extracts. Now, the extracts now, for extracts, what do you have? You have extract of PWL's statement of profit or loss and other comprehensive income. Now here for the year, this is for the year ended the 31st December 2021. What do you put? Here, what do you put? Of course, here, these are just extracts. You don't need to look for sales. These are just extracts. So what you put here is we have other incomes. Number one, we have other incomes. Other incomes was what? What you realized No. Yeah, what you realized here. What you realized this one, like this one, the double entry for these colleagues, this one, is that you debit, you reduce the liability, this one. You debit the deferred grant, the deferred income. You reduce the liability by 1.6 million. Then you credit what now? You credit your revenue. You credit the PL. The PL. You credit the PL. It means that this one now, the standard is allowing you to claim, to recognize it as the real income. Okay, that is the meaning. Okay, so it means that here we have the grant income realized. You can just put the amount the way it is, 1.6. Or you put shilling 1.6, then you put here shillings in a million. Okay, then what else do we have? Remember here you're looking at transaction 1 and transaction 2. From transaction 1, we had our income. We had income somewhere. The growth. We had the growth. We had the growth of what? 10, rather 40. We had the growth. So we have also the income from the growth of tree. That is the fair. It can be the fair value gain on the fair value, or the income from growth of tree. Growth of tree. If it's a loss, you put it under expenses. So that was 40. We don't have any other income. What is left is what? Expenses. Expenses, you have what? You have depreciation. Depreciation of your pruning machine, depreciation of the machine. And that depreciation was how much? You put the figure in bracket. That depreciation was how much for the year? That is 4.5 million. The one we have time apportioned. Then what else do we have under expenses? We have the plantation maintenance expense. The plantation maintenance expense, which is what? Which is 45. Okay, let me remove million because I'm already keeping these figures in a million. Okay, what else? I think those are the only expenses. And those are the only items to appear in our extract. Then you also do the same. Extract this company's extract. Here you do statement of financial position as at the 31st December 2020. Here, what are you going to put? In a balance sheet. Let me keep also shillings in a million. In a balance sheet, what are you going to put? You have assets. First of all, you have non-current assets. And under non-current assets, you have the pruning, you have the PPE. The PPE, that is the tree pruning machine. The tree pruning machine. And the carrying value is how much? The carrying value, we got how much? 1135.5 million. Are you saying that? Huh? Are we still together, colleagues? Hmm? Or I'm doing these things
Yes,
alone?
please. We are.
Okay. Do we have any other asset? Yes, a biological asset. Biological asset. Remember, we record at fair value. So this biological asset is what? What is the name of this biological asset we are recording here? What is this biological asset we are recording here? Planted pine tree seedlings. Okay, pine trees. Okay, so that was how much the fair value at reporting date. It was how much? 340. 340 million. Okay. Hey, already I'm keeping millions. So okay, then do we have any other? We don't have current assets. Maybe someone could say, let me adjust for cash. It's also, but because you're looking at year end, then the cash you cannot adjust it. Okay. Then we have liabilities. We have liabilities. Under liabilities, we have current liability of deferred grant or deferred income less than 1 year. And then you have the non-current liability. That is the deferred income of 1 year, above 1 year. Remember, when you're looking at liability, you're looking at in the next 1 year. Will you be able to settle that liability? If you cannot settle that liability within the next 1 year, that is non-current. But if you can settle the liability within the next 1 year, that is the current. Okay, so here we have already the figures. That is 2.1. Then here it's what? It's 3. It's 38.3. It's very, very key. It's very, very key because it's very, very key to know when you receive the grant. Because in a scenario where you receive the grant, let's say you're dealing with 2024. Assume you're dealing with 2024 and you're looking for the what? For the non-current liability. What do you do? Of course, the current for it remains like this. It depends on the amount you have. Like every year, amortization, your amortization of grant is this. So within the next 1 year, you'll be expecting it to settle or to clear this, to recognize this. So, but the problem is always here, how do you get the non-current? Now, if it's 2024, you get the original deferred income was 42 million. You remove what was recognized in the first year. If you recognized, let's say, in the first year 2021, you recognized what? You recognized how much? 1.6. That is the first year. Then that was in 2021. In 2022, you recognize the 2.1. Then in 2023, you recognize the 2.1. In 2024, in that year ending 31st December, you recognize 2.1. Like that. So the balance minus also what is going to be recognized in the next 1 year. That is in 2025. That's what you do. The one you recognized in 2021 minus the one you recognized in 2022 minus the one you recognized in 2023 minus the one you recognized in that very year minus what you recognize in the next 1 year. Then the balance will be what? Will be your deferred will be your non-current liability. Is it clear? Is this clear? Especially on non-current, people mess up here. It all depends on the year you're handling. It all depends on the year you are handling. You see this? You see this? Okay, so that's all for this question. That's really all for this question, and I think I'm really exhausted already. I'm really exhausted, but when you check this, there is a year that where they asked to define the income approach, the meaning of income approach, and also the meaning of capital approach under IAS 20. Income approach is an approach of accounting for government grants, whereby a grant is recognized in PL, in profit or loss, over one or more periods. Because like now we are saying that you can every year you're recognizing this. Every year you're recognizing this. So it means that now with income approach, you can recognize the government grant over its useful life. But when it comes to capital approach, this one is where the grant is directly credited to the shareholder the shareholders, the shareholders fund. The shareholders fund. You immediately, if it's capital grant, you immediately recognize that and equity. You credit your capital immediately. You don't spread. You don't say that every year you will be crediting a capital of this. No. If it's capital approach, everything you immediately recognize under equity. But this approach is not common. This approach is not common. And there is always arguments that support a very, very core theory that is normally asked. You explain the arguments. You explain the arguments in support of income approach over the capital approach in recognizing the grants. There are 3 points here. And number 1, it's that the grants are received. Okay, I can say the grants are not received. Are not received from shareholders, from the shareholders. How would you credit the capital yet the grant is not coming from the shareholders? Who will receive dividends? So here the grants are not not received from the shareholders. So should not be recognized, should not be credited directly to shareholders interests. Okay, that is argument number 1 that supports income approach, that because this grant is not coming directly from shareholders, it should not be credited to the equity part. Okay, then number 2. Okay, number 2 is that grants are extension of fiscal policies, and so as income taxes and other taxes are charged against income. Grants are extension of fiscal policies. Grants are extension of fiscal policies, and so as income taxes and other taxes charged against income. Okay. In short, we are trying to say that try to match revenue with what? Revenue with taxes. Like, it's not that you have actually earned this money. in a simple, it's not like you have not, and it's like you have not earned this money. So what will happen is that for you, you will start using grant. Okay, in this year. But in this year, we are saying that the taxman should take his part of this year. How much did I generate? How much did I generate when it comes to this point? How much did I generate as actual income from this grant? Okay, so you tax that. You tax that I have generated from this grant. Okay, I have only realized the portion. It's not that I have realized everything. Okay, that's how you should look at it. So grants are extension of fiscal policies, and so as income taxes and other taxes charged against income. So what do we mean here? It means that therefore your grant, so the grants the grants should be credited income. Okay, then lastly is that the grants are not given or received for nothing. You cannot just receive grants. They are earned by compliance with the conditions, and by meeting these conditions, by meeting obligations. Okay, and by meeting obligations. Okay, so what does this one mean? It means that therefore they should be recognized. They should be recognized in profit or loss over the periods in which the entity recognizes as expenses. The entity is recognized as the expenses of the related costs for which the grant is intended to compensate. But it's still the same it's the same thing. It's the same thing. So colleagues, that's all.